Okay, fam, welcome back. So today we're going to be going over FEPI and AIPI, and we're going to find out if these funds are really truly worth owning. So with that being said, let's get it. All right, so the first thing I want to start out here with is the homepage. Most of this is going to be about FEPI. We'll talk a little bit about AIPI, but they are essentially more or less the same fund. The difference is this is for basically the FANG stocks, although it holds more than the FANG stocks, whereas AIPI is more kind of AI focused, which in my opinion could actually be more bullish than the FANG itself because, again, AI is more than just the Mag 7. It's basically any AI company in the future that does extremely well. All right, that includes Palantir. Palantir is, I know, a lot of people's favorite, and we've owned it as well. So we're going to get into the prospectus here in a minute. Let's go over little details of this. Okay, so the current yield is 25%. That is very high for a dividend-paying ETF or a stock of any kind. So, yeah, that's as of the most recent payout. Okay, so there's a couple things I want to note here. It says that current distributions may include return of capital. For full details of the composition of distributions, please refer to the whatever this is. You guys will have to look into that. Look, what I can tell you about ROC or return of capital is, as far as I know, at least here in the United States, return of capital is not taxed. Okay. So even though it's paid out as a dividend, and again, double check with your CPA on this one. This is not financial advice. I'm not telling you guys this with certainty. Okay, laws change all the time. But last time I checked, our return of capital is not taxed because, again, it's exactly what it sounds like. It's your money being returned to you. Which in this case, as long as it does not, in my opinion, return of capital is actually a good thing as long as the NAV price or basically the price of the fund doesn't decay as a result of the return of capital. As long as that does not happen, in my opinion, return of capital is actually an extremely good thing because the price of the fund is sustaining its value or going up, and you're getting essentially tax-free dividends. Which the only way you can get that is with return of capital. Again, return of capital is not a dividend. They're two different things, but just, something to note there. So you got all your basic, financial information here. We're not really going to go over that. So basically what FEPI is, it looks like they do what's known as a buy right strategy. So they basically just buy the shares and then they turn around and do covered calls on them. I don't know if they're selling cash secured puts on these positions or not, but it is possible. You don't have to do the wheel. You could do cash secured puts, get into the position, and then do cover calls to get out of it. There have been some cases where we've done the buy right, where we basically just buy the shares. Again, it kind of depends on like the technicals. If we get the golden cross, we may use that as a reason to buy the shares for the bull move, and then use the cover calls to actually produce income. In that instance, we would be basically using options and TA as a combination instead of just going strictly with options with the wheel strategies. So that might be what they're doing here. I'm not entirely sure. So basically, the combination of that produces the actual income here. So a lot of what we're getting paid presumably should be from the options premiums. Again, a lot of these tech companies or AI companies that they're using pay extremely high premiums. If you actually own 100 shares of any of these companies, you're probably going to get paid quite a bit of money in options premiums, would be my guess. Okay, so current NAV price 51.43, closing price 51.44. So you can see there's not a lot of deviation here, which is good. That means that the price, in my opinion, the price of FEPI is relatively stable. Whereas if you took a look at something like RIV, for example, sometimes it's significantly under its NAV price, sometimes it's significantly over the NAV price. So in my opinion, this creates a potential for price stability. And again, you have your spread here. Again, 0.18%. That's nothing. That's not a very large spread. Discount to premium is also almost non-existent. So that's very good in terms of stability. So they have a total number of 48 positions. Again, I don't know exactly how they got to 48. Maybe there's multiple different positions on these that they have. I'm not sure. But these are the 15 stocks here, as you can see. And Yeah, so I'm not sure where they got 48, but you got 7 million shares. Again, that is a lot. I mean, if you had 7 million shares, if you have all of the shares of this fund, you would be making like $9 million a month, which is insane to think about. So the funds under assets under management, again, is quite small compared to something like JEPI, which I think has like, I can't even remember. It's in the billions. It's a lot. But 390 million is definitely no chump change for sure. So that's decent. I assume that's going to grow over time as this thing continues to perform extremely well. So this does pay monthly dividends, which is fantastic. We love that. Again, the dividends have been relatively stable. So you basically, for an entire year, you've had pretty much a 10-cent deviation, not really a whole lot here. So 110 to 120. So you got all these different companies here. You got Broadcom, Micron, Nvidia, AMD, CRM, Meta, Intel, Apple, Tesla, and Netflix. Tesla has absolutely bonkers premiums on the actual shares. Again, I think it's like something around $1,200 a month. If you're doing weekly options on Tesla with roughly about a 30 delta per 100 shares, so it really is a lot, which explains why this fund pays so much money, because a lot of these, like Nvidia, for example, or especially something like Micron, super, super volatile stocks are going to pay a lot of money by themselves in premium. So the combination of all of these, I mean, the premium is just going to be absolutely through the stratosphere, which again, in my opinion, is why we're getting paid so much money, because you got to understand the difference here. Okay, this fund is paying based on options premiums, whereas something like SEHD is paying based on dividends. Okay, options premiums usually, especially with well-established, extremely volatile companies like this, is always going to pay a lot more money than dividend paying stocks or ETFs for the most part. Okay. The difference here is that with the options market, there's a little bit more risk involved. Okay, these are tech companies. They don't pay dividends usually. I mean, they just recently started paying dividends, like Nvidia pays one, Apple pays one, but they're not dividend. Well, some of them are dividend growers, but they're not like, they haven't been paying dividends for 50 or 60 years, if you know what I mean, increasing dividends for that long. So there's some risk. You get into an options play, a cash secured put, or a covered call, and you could get completely dumped on or pumped on, and then you get dumped on in a cash secured put, your share price goes way down, and then you basically got to wait for it to recover or average down. That's something that, and the flip is true. Like if you get, let's say, you have your average price of Tesla is $200 a share, and you put on a 220 strike price on your covered call, but then Tesla, by the time of that expiration, goes up to 260. Well, you just lost out on $40 of premium, or $40 of profit in exchange for premium times 100 shares. You just lost out on $4,000 in profit, even though you got paid premium. So there is some risk there. Okay. But generally speaking, options premiums do pay a lot more than dividends, unless you have something like, I don't know, something like SFAL. But again, SFAL is not really based on dividends and dividend paying stocks. So you can see the difference here. All right. So, so it says it's an innovative ETP provider, which again, I believe is exchange traded product. I'm not sure how that differs from an ETF, but it says it specializes in alternative strategy ETFs and ETNs. The firm created the microsectors and co-created the T-Rex product line of leveraged and inverse tools for traders. And it says they have decades of experience, so that's definitely always a good thing. You don't want to have somebody that is in charge of a fund that has zero experience or doesn't know what they're doing, or makes really bad decisions, because, again, people are investing their hard-earned money into these things. So in terms of the actual payout here, so you can see the total payout for basically since inception, you would have gotten paid $12.58 per share, every share that you've owned since the inception of this thing, okay? Assuming you got in before the X date of the very first payment, which would have been November 27th of last year. So if I go over here to the total return, or the price return, I should say, you guys can see that the starting listing price of this was $51.67, whereas the current price is $51.46. Again, we are right before the elections, kind of peak uncertainty. Q4 is usually pretty bullish for stocks and crypto, especially during the halving year for crypto. But for stocks, it's almost always bullish because, again, you have you got like the elections, you got the midterms, you got holidays. Um, it's just a lot of things that kind of serve as tailwinds for bullishness. So, in my opinion, I think FEPI is likely to go up into the end of the year. I don't think it's going to stay at these prices, but even if it did stay at these prices and basically the price currently is just flat, you're still getting paid a total return of $12.58 on the share price. So you could basically just tack on that $12.58 onto the current price, which would give you an average price of roughly about $64 a share. So you can see we own this. Okay, we're currently down about $480. So if I were to times this, basically times 100. Again, we haven't had 100 shares since inception, but you kind of get the idea that basically the amount of total return we have would significantly outperform the actual performance of the price of the fund. Going over to AIPI. Again, I do expect AIPI to have massive returns in the future. Again, this is an AI ETF. This is huge. Okay, I don't know if you guys understand how big this is. The future of AI is going to be eye-poppingly massive. Okay, we're probably talking hundreds of billions, maybe even trillions, or even tens of trillions of dollars going into AI, and that AI itself is going to produce. And I know a lot of people are worried about like job destruction. Okay. Look, here's what I estimate is going to happen. I don't want to get too deep into this, but here's what I estimate is going to happen with the advent of AI. Maybe a lot of jobs will be destroyed, but a lot more jobs will be created. And you guys got to remember, during that time frame, there's going to be a lot of baby boomers that are going to retire from the workforce that are no longer going to be working or retired, or, I don't really want to talk about what happens after life, right? But those vacancies in the new upcoming revolution with AI are going to need to be filled. Okay. So with all those people retired, combined with how many more jobs would be created with AI, in my opinion, there's going to be a deficit. There's going to be a surplus of jobs because there's going to be so many of them that there may be basically all of the people available may need to fill those jobs, and they may also need AI on top of that to fill some of the vacant jobs. That's kind of what I suspect is going to happen. So AIPI pretty much almost on the dot is flat. It's actually up a little bit from inception. So kind of a lot of wild swings here. A lot up, a lot down. But again, July, August, somewhere to maybe September, October can be kind of bearish a little bit. Again, that August, September time frame is usually bearish seasonality. We're getting through that now. So I do expect AIPI to go up in the future. And again, we do have this one. We also have 100 shares of this one with an average price of about $53. Okay, so going over the prospectus here of FEPI and AIPI may be a little different from this. The important thing I wanted to note about this is it says the fund may purchase and sell a combination of standardized exchange traded and flexible exchange options. Again, I have no idea what flex options are. You guys are going to have to look into that. Call options, again, which I presume is when they say purchase and sell, I'm assuming that they're buying the whatever the flex options are or the actual stocks off the market directly with the money that they have. I could be wrong about this, but I assume that's what they're doing. They're not doing cash secured puts. They're just buying outright, and then they're turning around and doing selling call options on the market for the premiums that are based on the value of the price returns of underlying instrument. So yeah, I mean, this prospectus is pretty long. You guys can read into this. The point I wanted to make here about this prospectus is actually this. So all these different markets that you guys are seeing right here, semiconductors, electronic components, instruments, telecommunications, processing, all this different stuff you have in here, data processing, package software, internet services. That is the wave of the future. Okay, that is now to the wave of the future. 10, 20, 30, even 50 years from now. These things that they have in these funds are going to be much more valuable. And like I said, in my opinion, AI could be worth hundreds of billions, if not trillions of dollars in the future. These things are going to grow economically over time. Okay. So I'm expecting the funds to grow with it. Now, they may not grow as much as some other funds that don't pay as much in dividends, but that's the point of this fund, is to pay a combination of price appreciation and dividends, which they do to some extent. It just depends on whether the market is actually going up or not. So AIPI, this is a relatively new fund. Again, it hasn't been out for a long time, 67 billion. But I do believe, in my opinion, this is going to become a very popular fund in the future. Why? Because it's based on AI. And again, AI is the wave of the future. Okay. I've been doing this long enough to basically tell y'all that, look, I'll use an analogy here. Okay. When Bitcoin first came out, everybody thought it was a scam. Oh, it's going to zero, blah, blah, blah. How many people wish they would have bought Bitcoin at a penny, 10 pennies, $1, $10, $100? Now Bitcoin's at $60,000, and you got people like BlackRock and Fidelity, the largest money managers on earth, with $8 to $10 trillion in assets, buying these Bitcoin. Okay. The same thing that at one point people, a little room of people created, I think they were called the cypherpunks, where they were trading or something like that when, this thing was pennies on the dollar. Now the biggest institutions and governments in the world are buying this thing. What was once nothing and everybody mocked eventually became massive and everybody wanted a piece of. I expect exactly the same thing with AI. So at some point, this fund and other AI dividend ETFs are going to become very, very popular. People are going to love them. They're going to want more of it because it's just simply the wave of the future. So in terms of total price return on this one, rounding this up, this would have been about $4.50. Again, the price is relatively flat here, but we're going into bullish seasonality, so I expect it's going to keep going up. But as of right now, you'd be up about $5 per share in total return, which in my opinion is better than zero. I mean, most dividend investors, they care about one thing: total return, price appreciation plus dividend distribution. And again, there is a couple other funds in here. I don't know what Datadog is. I'm assuming that's probably a pretty good fund as to why they have it in there. Arista Networks is basically just a moonshot. That thing pretty much has only ever gone up. Palantir, that's becoming a very, very popular stock in the space. And of course, you have ARM. That's a big deal too. I believe NVIDIA tried to get a partnership with ARM at one point, but the government kind of stepped in and they're like, nah, you're not going to do that. So yeah, that kind of sucks. But NVIDIA by itself is basically a titan, so not too worried about that. Anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.